To understand whether this is a temporary shock or the start of a new trend, you need a simple diagnostic. Did the move come from fundamentals or from repricing and positioning? In the short run, gold is often driven by the repricing process, real yields, the dollar ETF flows, and speculative crowding. That means the next 2 weeks matter because the market will either confirm the new expectations or reverse them. Start with real yields. Watch not just nominal bond yields, but inflation expectations relative to them. If yields rise while inflation expectations hold, real yields tightening, gold usually struggles. If yields fall or inflation expectations rise faster than yields, real yields ease and gold tends to stabilize or rally. This is why gold can fall even during bad news if the market concludes policy will stay tight. Second, watch the dollar's trend. You don't need a perfect model, you need direction. A persistent bid in the dollar often caps gold rallies. A clear rollover in the dollar removes pressure and allows gold's underlying demand to show itself. Third, monitor ETF flows and the story trade. If gold ETFs see sustained inflows after a shock, it suggests longer horizon buyers are stepping in. If outflows continue, the rebound is more likely to be sold. Positioning data can help confirm whether the market is still crowded. When positioning is extreme, reversals are sharper and confirmation takes longer because the market must first unwind. Now the timeline. Over the next 2 weeks, the most important question for gold is whether the market is done repricing the path of real yields. Typically, the first week is about shock absorption, volatility spikes, narratives multiply, and positioning resets. The second week is the confirmation window. Either gold fails to regain key levels because the new regime is real, or it stabilizes and forms a higher low because the shock was temporary. A practical way to frame it is 3 outcomes. Outcome 1. Gold consolidates and holds above its recent flush low, while real yields stop rising, bullish stabilization. Outcome 2. Gold retests lower levels, but the retest is weaker than the first drop, constructive, because it signals forced selling is exhausted. Outcome 3. Gold breaks down again as the dollar strengthens and real yields climb, confirmation of tight money dominance. The point is not to predict a single price. The point is to track the drivers that actually move gold. In a rate shock, gold reacts first because it prices the regime change. The next 2 weeks determine whether that regime change is real or just a temporary repricing that the market will unwind.